Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Consumer spending is holding steady despite tariff announcements and a widening trade deficit. U.S. consumer spending increased solidly through the month of March. But are we out of the woods? And how is Fidelity's research culture empowering analysts to challenge ideas and drive results? Very happy here to be joined today by Director of Research and Portfolio Manager Steve MacMillan and Equity Research Analysts David Cochrane and Nic Everett. This is for a look at what is driving U.S. equities and where opportunities for investors just might be. Steve, David, and Nic, a delight to see you all. Thank you for being here.
Thanks for having us.
Here, let's begin, if you don't mind. Steve, I'll begin with you. Tell us a bit about these wild markets, where you have been holding on, where you have been finding opportunity. Things are switching up a bit.
Yeah, I would think about it as like I was a shopper going around the grocery store and not being able to buy anything because everything was too expensive the last few years. Now I feel like I'm walking around that same grocery store and everything's on sale. And for me, this is a great environment. All of a sudden, I'm finding great businesses that I was really priced out of, now really coming into that basket of the portfolio.
How big are these companies? What's the range of companies that you're looking at, their size?
So I've got my small cap America fund, and I typically keep stocks kind of under 10 billion, which from a Canadian context, there's probably only about 40 companies in Canada with a market cap above 10 billion. And then in the American equity fund, the sky's the limit. But mostly what I'm doing is focusing on all of the small and mid-cap companies. And speaking of grocery stores, one of the largest holdings in the portfolio right now is a company called J.M. Smuckers.
Jam.
Exactly. And what I love about it is Folgers Coffee, which is the largest coffee brand in the world, Jif peanut butter, jam, Uncrustables. These are all products that you don't have to believe in humanoid robots. You don't have to believe in cryptocurrency. This is businesses that are stable, growing. And so I think we're seeing this rotation in the market away from dream stocks to cash flow stocks. And that's right where I sit. And so if you look this year in the first quarter, the best performing relative funds with the name Fidelity on them were managed by people like Dan DuPont and myself, because we're seeing this rotation away from those higher growth areas of the market to these more stable cash generative businesses. And so what I'm doing is I'm scouring the market, trying to find stocks that I think are on sale. And if you look this year, I've had 9% of my small cap portfolio actually taken out because valuations are getting really compelling. Skechers was the most reasonable,
yes.
The most recent. And what I'm doing is I'm relying on folks like Nic and David to find me those ideas. And they're doing a great job coming to me with these ideas.
Fantastic. That is so interesting, because we've sort of been hearing about this. We were giving some real solid examples on how they fit in ultimately to your portfolio. David, I'll ask you to just explain what you do. You're looking at the consumer. We're going to ask you a lot of questions about consumer sentiment. What do you cover?
Sure. So I cover North American consumer discretionary, and that covers everything from restaurants and retailers to leisure products, think buying a new snowmobile or ATV, to leisure facilities like gym chains and other areas in leisure. So it's kind of the whole gamut within consumer.
Okay, fantastic. And Nic, I'll ask you to take us there. It's also related to the consumer, but this is financials.
Yeah, so I have the pleasure of covering U.S. non-bank financials, which is a broad term, but if we're thinking about the key parts, payments for me, so think like the Visas and the MasterCards of the world, all the way down the stack of different payments related companies. And then I have exchanges, so think the structure of the markets, companies that benefit from more activity. Generally, I have info services, so rating agencies, index providers. And then I also get, a smattering of more topical, growthier type companies in themes like buy now, pay later lending, cryptocurrency trading, and retail e-brokerage companies like Robinhood that are dealing with the U.S. retail investor.
And there has been some trading going on lately. David, in terms of the sentiment that we hear about, which is a bit gloomy, let's be honest, there are lots of discussions about whether there will be or won't be a recession. What are you hearing CEOs say right now? And then we'll ask you, Nic, are people paying up for things? But first of all, David, the sentiment, is it just soft data? Is it something that you're concerned about?
Well, I think what you're hearing differs within consumer from company to company. So what you're seeing is companies that sell big ticket items, think a new boat or an RV, they're seeing continued soft demand, even as compared to last year, which was also soft. So really, folks being a little more hesitant to pull the trigger on buying those big ticket items. On the other hand, you're seeing the everyday essentials, some of what Steve talked about, where people are still buying their peanut butter, whether or not there's a recession. And then you have areas in the middle, like travel and restaurants, where you've seen a little bit of softening after some strength. You've seen some softening to start 2025. And the question is, okay, is this the beginning of something, or is this just a blip? And, this is the kind of environment that we really like at Fidelity, because we meet with our CEOs all the time. We're constantly tracking data. We're talking to industry experts. And we're trying to figure out how do these diverging trends create opportunity for us to form views on what these companies could earn and where those views diverge from the stock prices.
Okay. All right. So we'll do more on that. First of all, Nic, what about on the payment side? Are people still paying up? What are you noticing in terms of trends within payments?
Yeah, so we get to see these trends pretty closely. I mean, Visa and MasterCard effectively encompass spending for the entire world, but specific to the US consumer, what we've seen is they're holding in. So despite softer sentiment metrics. So through the first quarter, there's some noise around things like weather or leap day timing, but if you're looking through it, it looks like spend trends are generally holding in a good place. And specific to April, which is where there's a lot of focus, given this is coming after this novel trade war environment, we've generally seen spending hold in, but with a couple of caveats, which is that we're seeing some category shift under the surface. So specific to April, it seems like we're seeing weakness in pockets like travel and leisure, and where we might be seeing some strength is in categories that the consumer would perceive as tariff pull forwards. So think consumer electronics, maybe you're pulling forward your iPhone purchase because you're concerned about tariffs coming in and taking prices up for that product, or we may also be seeing some strength in autos.
Okay, really interesting. So, Steve, how ultimately, let's kick off the tariff discussion. Nic just alluded to it there a little bit, but let's talk about how that affects some of the stocks that you're following, what you might be prepared to buy ultimately for the portfolio. It's a live and moving story that we don't really know where it goes. How do you invest amidst it all?
Sure. So the most important thing, I think, in this scenario is asking yourself whether or not a company has pricing power. So you remember when we had tax cuts under Trump 1.0?
Yes.
You had these two groups of companies. You had companies like, say, banks, retailers that were very high domestic tax rate payers. That if you just did the simple math of tax rates going down from 40 to 25, there'd be a huge increase in their earnings. But in reality, what happened was they competed it all away. If you're a retailer and you're fighting with Walmart and you're fighting with Amazon, you can't just keep that. You have to pass it on to consumers. But if you look at Google, that David used to cover at the time, Google's going to keep that tax benefit. They don't have to pass it on. And what are tariffs? They're sales tax, ultimately. And so I think if you look at the companies that have a good competitive structure, they'll pass on that sales tax. And the ones that don't, they're going to really suffer. I think ultimately this is going to be more of a volume and demand issue, because anytime you raise sales tax, you take away money from the consumer's wallet, and they have less money to spend other places. And so if you look at a company like Skechers that I mentioned earlier that got bought out, stock went from 75 to 50, and the concern was they were a big importer from China and Vietnam. But ultimately, all children's shoes are made in China. And so if there's...
regardless of that company or any other.
Yeah, and so they actually have an advantage of scale versus everyone else. And so to think that their earnings are going to collapse because there's a tariff, ultimately it's going to be the consumer that pays for it. And so one of the things that I'm talking to all the analysts about is make sure your companies have a great competitive position so that regardless of what happens on the tax structure, they're going to be okay.
Okay, so take us inside some of the areas within consumer. So you mentioned restaurants a little bit. Let's go a little deeper into what types of restaurants are doing well right now, where people want to spend their money, where they're, again, maybe like travel, just saying no, not right now.
Sure. So there's two big themes in 2025 in restaurants. The first would be around fast food restaurants, and specifically their push into value. As you know, the cheaper hamburger is it. So since COVID, we've obviously seen tremendous inflation in all categories. US CPI is up 20-something%. But what's interesting is fast food inflation has been even greater. So fast food inflation has been over 30%. All of a sudden, it's not that cheap to go to McDonald's.
Not that fast or cheap, yeah.
That's it. And so for these fast food companies, what they've started to see is a bit of slowdown in traffic because people are just going less as it's more expensive. And in 2025, what they're doing is leaning back into that value offering. So can we pay $1 more and get an extra burger, or get 3 items for $7? And it's important for us to observe, what does that mean for these companies? Are they able to drive traffic growth again? Is one company going to take market share from another because they lean into value? And so that's one of the key areas in restaurants in 2025. Another key thing that we've seen is the divergence in trends among some of these fast casual players. Okay. So these are a group of restaurants, mostly in the US, who are trying to be the next Chipotle, basically.
Okay.
And what you'd seen is there were a number of these concepts growing very quickly as we were coming out of COVID, people coming back to the office, going out for lunch. But more recently, as the consumer has gotten normalized their behavior a little bit and maybe soften their spending slightly, you've seen a real divergence in trends in these buckets. And restaurants that are offering something really unique in terms of customer experience or cuisine, they're continuing to hang in well. But a bunch of the other smaller concepts who were doing quite well, they're starting to hit a bit of a wall. And so that creates an interesting stock picking opportunity for us.
That divergence is fascinating, and sort of what people are walking in and wanting to spend money on. Let's talk about the amount of money they're spending, and again, how you're kind of seeing, there's a restaurant system that is a bit somewhat new. It's an area where you don't just make a reservation, but you pay through the whole system. Tell us a bit about this.
Yeah, so within the payments market, the key debates today are not at the Visa and MasterCard level. They're one level below with these companies called merchant acquirers. And over the last 10, 15 years, the primary business of merchant acquirers was going to your local small business and helping them get onboarding acceptance of cards like Visa, MasterCard, American Express. It would be not too different from like a company you'd go to sell you Wi-Fi. That was their whole business model built up on this. And these businesses today are facing serious disruption for two reasons. One is the payments piece of the product is becoming a commodity. And because it is becoming a commodity, other companies that are adjacent to the payments business, whether it's like a software provider, they can now sell that payments piece in competition to these legacy companies. And then the second piece of disruption that's happening is just huge amounts of technology getting sold to the SMB, the small business that wasn't previously being sold. And so I think this is best explained in an example. So I recently went to dine at Earl's, Canadian restaurant chain. I grew up in North Vancouver, so I've been eating there for 20 years. And if you're inside, it's a very complex operation today, right? They have online reservations, front of house reservations. They have iPads by the table side that are taking the orders. Those iPads are reeling orders to the kitchen. The kitchen is also getting orders from the online orders that are coming in for delivery. There's now huge amounts of complexity that's really being enabled and facilitated by new technology. And what we're seeing is there are companies that are coming to the market today. So one example in the US market is a company called Toast, where they're selling the whole package.
Good
the payments
name.
And the great name, the payments and the software package. And it's creating this huge war in the system where these legacy payments companies are fighting for the right to exist, while these disruptive software companies that are layering the payments are aggressively attacking that legacy market. And it's creating this massive divergence in share prices in the public markets, which is giving us a great stock picking environment. Do our deep due diligence, pick our winners, pick our losers, figure out where the greatest mispricings are, and hopefully make a lot of money for our fund holders.
What's your go-to order at Earl's?
Oh, it's not even a question. It's if you know, it's the blackened chicken with the warm potato salad and the...
I don't know, but I'll check it out. I'll check it out. So, Steve, you're putting together all of these ideas. Fascinating, the disruption and the divergence there. How do you use that?
Really, it creates the opportunity to talk to the analyst team and see what they're seeing. And so if I just rely on myself, I'm one person with one set of eyes. But if I rely on the 160 analysts we have, all of a sudden I'm finding a lot more opportunities. And so we're seeing this wide divergence in stocks right now as companies are really unclear what their earnings estimates are going to be this year.
Right. I mean, we're hearing that in the earnings reports that some are just taking a buy because they can't tell.
Yeah, absolutely. And so what I'm trying to do is find businesses that can do well in spite of the economy rather than because of the economy. And so I just had a meeting just before I came here with a CEO of an insurance company that I own. It's a company that's trading a little over book value that thinks they can earn a mid to high teens return on equity, which means they can compound that book value at that 15, 16, 17% over time if they hit their targets, which is hopefully the stock follows over a long period of time. But the thing that I like about it is that they're not dependent on a strong economy to achieve those results. And I have a lot of stocks in the portfolio that are currently in the financial sector because I think that areas like financials, some of the payments areas, they can actually be quite agnostic to the broader economy. And so if I can find them trading at low valuations, I think they can do quite well. I think we're seeing a real shift in what's going to drive the market. And I think what drove stocks over the last 5 to 7 years, which was really growth, large caps, tech, isn't going to be...
Low interest rates, too.
Yeah, isn't going to be what drives it over the next 5 years. And so if you look at both my portfolios, despite the S&P 500 having something like 35, 40% in tech, I have single digits in my tech portfolio right now because I think valuations have gotten out of hand. I think some areas that might seem really sleepy, like consumer staples, financials, consumer discretionary, can actually be really good performers. Companies that trade at low valuations, that have high cash flow generation, I think are going to do really well. This reminds me a lot of when I first took over the portfolio coming out of the GFC, where we had this malaise of an economy, and companies that could do well in spite of the economy, generate a lot of cash flow, could really compound over time. And that's the area of the market that I'm doubling down on right now.
That's fascinating. Okay, let's go to consumer discretionary, consumer staples as well. We've been talking about some of them. The stuff that we have to buy, not restaurants, but stuff that we have to buy, is more expensive. And so we are, I think, cutting back. But what are some of the companies that are on the discretionary side of things that got a bit blown out there for a while? Are they looking attractive?
Yeah, I think what you've seen specifically, since the beginning of April, when you had these large tariff announcements, Trump held up his tariff board and shook up the entire consumer land of the stock market. You saw a really big divergence with some of these more stable companies, their stocks performing well on a relative basis, and some of the companies most impacted by tariffs, an example being Skechers, which Steve talked about earlier, just experiencing a lot of relative underperformance.
Or toys,
and so
something we keep hearing
toys
about
is
too.
another area that has a lot of tariff exposure. And so what we've done is, even leading into these tariff announcements, we have such a deep analyst team here, and we're calling our companies to understand what kind of exposure do you have? Where do you make these goods? Where do your competitors make the goods? What could you do if tariffs hit? Could you raise prices? Could you take out costs? And understand really what the impact of tariffs was. And that big divergence created an opportunity to buy some companies that maybe, yes, they're impacted by tariffs, but they're able to mitigate a fair bit of it, and ultimately not in a different competitive situation. And so that gave some great entry points. It also helped us dodge some situations where companies are impacted, they don't have pricing power, they're in a worse competitive position, and we should continue to avoid them. So that's what the benefit of the big team does in our management access, just being able to understand company by company, what is the situation.
Amazing. It allows you to make those choices. Let's go into insurance. You cover insurance as well?
No,
non-exchanges. No, actually, I thought non-bank, thinking insurance. That's where I was going with that. Let's go to the exchanges for sure. They've been busy. This has been an amazing place. Would you call it a place to hide or?
Yeah, I mean, I don't even know if it's hiding per se, but if you think about the current macro backdrop where you have companies expected to revise estimates downward on weaker economy, these businesses are rocking and rolling. Like we are, so these exchanges, they benefit from more activity generally, right? So we want to see more speculation, more changes in position generally, more hedging, and all of these things accelerate in environments that are very chaotic. So what we're seeing is these companies, whether they're in futures or credit or equities, volumes are rocketing and estimates are going higher for these businesses, which has made them very high quality places to hide in the current backdrop. Key question now is just how durable is this current backdrop? How much of this is cyclical? Is it secular? And we have deep work going on just to figure out where these will land.
How does the growth and stability compare between small caps? Oh, I can't see that out of that, and the micro cap. I don't know if you're looking at micro caps, but yeah, just sort of that stability / risk story.
I would say once you start to get stocks that are sub, say, $1 billion, unless you find something that is a real niche. In the past, I've owned the largest manufacturer of buses in the world. Super stable business, but a very small market. So it was school buses. But most of the companies that are in that sub $1 billion mark don't make money, have uncertain futures. And so to go there, you're just really going out on the risk spectrum. And so, I've found some really interesting niche businesses in the past and put them in the portfolio. But most of the portfolio is probably more on the larger side of the small caps. The average market cap of the portfolio is probably in the $5 to $10 billion range. And I think at that level, it's a real sweet spot where your TAMs are still not limiting your ability to grow, but you're small enough that you can add value from a research perspective and find some really interesting niche businesses. And so just as an example, Nic covers a company for me called Euronet, which nobody's ever heard of. It's a hodgepodge of businesms. Maybe I'll let Nic kind of explain.
Is it not I thought it was an exchange.
Yeah, I mean, it's so Euronet is a mix of businesses. They do ATMs for travelers, primarily in Europe, and they do mobile wallet top-ups for people who have like video game currency in various markets, and then they do cross-border remittances. So think like Western Union in the United States, but growing faster. And that's the predominant business model.
Yeah, and so a company like Euronet, you're never going to come across that on your own, but it's trading at 10 times earnings, has a CEO that I've been talking to for 20 years that founded the company, and has grown it very consistently, made great acquisitions, and you can get that stability in a very niche business, being the number 2 money transfer company in the world, being the number 1 mobile top-up company in the world, all these little niches. They're the people that when you're at the Vatican and you run out of cash and you have to go to the ATM, you're like, how much am I paying for this?
I think that's where I just saw it, actually. Yes.
Yeah, and so they charge you an exorbitant fee to use their non-bank ATM.
Indeed.
But it's just a great little business that you can own for a long period of time.
Good heavens, that was very specific. I like that. Okay.
That's a personal experience.
Is it? Okay, good. How does the Fidelity Small Cap America Fund differ from the Fidelity Global Small Cap Fund, aside from sort of the geographic? What is the relevant overlap, would you say, in terms of the companies?
Sure. The company overlap's relatively small. So if you look at Chris Maldzinski and Connor Gordon, they have slightly different styles, probably different geographies. I think you're likely to get a lower volatility profile in the Small Cap America Fund, obviously totally domestic U.S. exposure. But Chris and Connor are amazing investors and do a really great job of uncovering ideas on a very idiosyncratic basis. And so I think the opportunity is likely, if you're looking where you want to fall on the risk spectrum, Small Cap America is likely going to be lower on the risk spectrum, lower volatility. If you look this year when the market was really at its troughs, the Small Cap America Fund was relatively flat when the Russell 2000 was down very materially. And that's really the kind of investor that's looking for the Small Cap America Fund and the American Equity Fund. I'm looking for someone that doesn't want to get scared out of their portfolio during periods of volatility and are okay with giving up some of the upside periods just to make sure that you make it through over that 5-year, 10-year period. And the same with the American Equity Fund. Yeah. It's had great absolute performance over the last 5 years, 10 years, but hasn't kept up with the NVIDIAs and the more exciting areas of the world.
David, we've got a couple minutes left. I want you to tell us a little bit about the consumer of the future. It doesn't need to be too far in the future, but what are some of the trends that you're noticing now that we kind of probably are going to notice in ourselves moving out a few months? What do you think it'll look like by the holiday season where we're trying to buy things? When we're looking to the end of this year, we think there may be just less stuff for the consumer to buy, but maybe the consumer's not in a place to buy it. What are some of the idiosyncrasies that you think we should keep an eye on about consumer 2025?
I think it comes back to tariffs and the macro situation and how both of those develop. So if you're in a scenario where tariffs end up sticking at these very high rates, you may end up seeing some supply shortages in areas that are exposed to tariffs, and toys is one of those areas. Do you end up with a few less presents under the tree, maybe? But you also have areas that are much less exposed. And again, areas like peanut butter, you're probably still going to be buying peanut butter, whether there's a recession or whether there's a tariff concern. And so, it depends on how that tariff and macro situation develops. But there are some areas that are much more exposed to that, and there are some that are much more defensive. Okay.
And as sort of a final comment, Nic, what's the most, they're all interesting areas that you cover, but what's sort of something you'd like to highlight on the way out of this conversation?
Yeah, I think if there's, one theme that I think is particularly interesting that we haven't talked about, it's just that the U.S. consumer is finding maybe new ways to get their excitement in their lives. So I think maybe not directly consumer related, but what we've seen in the U.S. is some very interesting product launches on the prediction markets, which is something that's very new. And as we get talked about, what this means is it's similar to gambling, but it's done in a market structure versus a house structure. So, you're betting at clean odds on things rather than whatever
games,
Vegas.
Sports?
Yeah, it could be sporting events or who the next president of the United States would be. There are even very insane low odds things like, will Donald Trump be the next pope? Like, those are things you can bet on at extremely low odds. Not that I'm saying that's worth your money, but
it's
just
a good
to suggest,
week for all these discussions.
Yeah, but what you're seeing is these are now starting to get rolled out more to the U.S. public. So Robinhood, which is a company that I cover, is starting to roll these out. And we might be starting to see some pressure on the gambling names by comparison, where they're heavily reliant on their sports gambling profiles, and they might be seeing some disruption. So.
Final word to Steve, got 30 seconds. What do you want investors to sort of take away from this moment in the markets? Because it is a changing moment, isn't it?
I think the message would be, if you're structuring your portfolio to do well in the future based on what's done in the past, I think you have it structured wrong.
Okay, I like that. Okay, Steve MacMillan, David Cochrane, and Nicholas Everett. I got your full name in there. Thank you for joining us here today.
Thanks, man.
Thank you for having us.
See you next time.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.